Hi, everyone. Chris Britton, National State Tax Director for IDC. I usually like to start things off with a joke. So this is Mr. Potato Head's doing his tax return with for him and his wife, and she asks them what they owe this year. And thanks to our current government, he's sending in parts of his body. And this is, I don't know if anyone's a Lord of the Rings fan, but according to our government, that anybody that does work that I do is an unscrupulous individual. So this is it's not the ring, it's a tax loophole. So I'm going to go a little bit deeper into a subject that's been talked about a couple times already, which is sort of the new capital gains tax rules, but I'm going to approach it a little bit differently in terms of exactly how it fits into integration and how it impacts AAII calculations, which is the passive income rules, which we've gone over a couple times today already, where if you're, go over 50,000 in passive income in your corporation, then you start to grind down your capital, your ability to claim the small business deduction. So integration basically says that if you pay a salary or a dividend, i.e. your company makes a profit and then pays out the retained earnings as a dividend, you should pay the same amount of tax. And in a situation where we have a dividend strategy being cheaper, we have what's called over-integration. And if we have a salary strategy being cheaper, it's called under-integration. And for years and years, there was over-integration. So you could save, depending on which province you're in, 3 to 5% by paying a dividend, which is what most people still think today. So if you talk to a business owner, they will generally think that it's cheaper paying a dividend. And it's simply it's not true anymore. And with the AAII calculations or the passive income rules, you may want to pay salary now, and I'll kind of get into reasons why. So this is an Ontario chart, and if you make $10,000 in small business deduction income, you paid it all out in salary, you would have about $4,600 left. And if you earned it in your corp and you paid your corporate tax, both the federal and the provincial portion, you'd have $8,700 left. And basically, if you turned around and paid that out as a dividend, individual would pay $4,192. And they would have $4,588 left. And you can see at the bottom that there's a negative 59, which is 0.5% of an advantage of paying a dividend. So if it's basically the same. If you have general income, and so general income would be any income not subject to the small business deduction. So generally over 500,000, or if you're getting ground down by the passive income rules, it could be something less than that. Then in most provinces you are over integrated, so you are going to pay definitely higher tax rates. So in Ontario it's about 2%, and I'll show you a chart that shows basically every province in a second. But what you'll notice is there is still a giant advantage to leaving money in your corporation, depending on when you need it. But if you don't need it for a while, there's a big deferral opportunity. So with low rate income, so income subject to the small business deduction, the deferral is about 41%, and if it's higher rate income, it's still 27%. You can see here that if you have tax savings at the small business deduction level, you'll pay slightly more tax, but not very much by paying out salary. Whereas the general income one, you can see, especially in this number of provinces, there's about 4 provinces where paying out a dividend if you have high rate income. So if you turned around, if you had income now, paid the tax, and then immediately turned around and paid out a dividend, in provinces like where I live in Nova Scotia, there's about a 4.5% cost to doing that. So if you had income over top of the small business deduction and you were still employing a dividend strategy, it's going to cost you 4.5% more than if you paid out a salary out of the high rate income. And over on the other side, you can see the deferral advantage. So the small business income column is kind of the one that I want to concentrate on, because that is the advantage of the small business deduction. And that is the advantage that helps you advisors help your clients have more money that you get to invest, whether it's in a life insurance contract or whether it's in savings and investments. So I'm going to slide through this pretty quickly because they did a pretty good job of covering it before. But basically, any income over 50,000, which includes rental income to non-associated companies, it would include foreign income, it would include interest income, it would include dividends from public companies. Does not include dividends from associated companies. It includes capital gains and interest. And anything over 50,000, your small business, your $500,000 small business deduction is reduced by 5 times $1. So if you got the 60,000, the small business deduction would be reduced to 450,000. The integration, so it shouldn't really matter on a cost level if integration is perfect. But if integration is if it's over integrated in some of the provinces, like I mentioned, Nova Scotia, then there is a true cost to losing your small business deduction. However, the deferral difference is significant. And for instance, in Ontario, if you had $50,001 of passive income, that $1 would cost you $5 of small business deduction. So basically that's 1 times 5, and the difference between the high rate and the low rate is 14.3%. So you'd end up with a 71.5% increase in your tax for that year. So basically, if you get to amount of passive investments and you're making 5%, if you get over 3 million, you're going to hit 150,000, and it's going to go to your small business deduction will get ground down to 0. So in Ontario, if you get ground down to 0, there is $71,500 you have less to invest inside your corporation. In BC, it's 80,000. In PEI, it's 105,000. So this is year over year over year what you've lost in a deferral to be able to save for your retirement. So it is a significant. It has a significant impact in no matter what province you're in, but on the ability to save. So planning to create the ability to hold on to that deferral advantage is very, very important. And it's one that needs to be done annually, because typically with investment portfolios, we've got pretty big swings in the market. So if you have 1 year where you have a really big capital gain, it significantly impact your passive income for that one particular year. But if the next year of a capital loss, then maybe now you're only including your interest income and your dividend income, and the impact's not as significant. If you've got gains and losses in the same year, you can use those losses to offset your passive income. However, if you've got loss carry forwards or carry back, they don't reduce your passive income. So if you want to use capital losses and you've had a capital gain during the year, there might be some planning to be done at the end of the year if you've got some pregnant losses and some investments that you might want to sell to be able to not have that the small business income grind. The new capital gains inclusion rate, as we've already been told, has gone up to 2/3. So that means that there's now 2/3 of your gain is included in your passive income instead of just 50%. The other piece that I want to talk about quickly is that the first 250,000 of gains that you have personally are not subject to 66.27. So now the integration on gain, like I'll call them low rate gains that you would have in your corp. So let's say you have less than 250,000 personally, but you have 250,000 in your corp. The integration to get those gains out to you personally is now super over integrated, and you're paying a lot more tax on them. So that loss, it's about 8% tax rate, and it's about 30% increase, 30 to 35%, depending on your province, in the actual the tax that you're paying on those gains. So in Ontario, the rate's gone from 26 to 35, and that is basically across the board. A 30% gain in the taxable portion of your gain. For estate planning purposes, this is very significant. If you've got high net worth clients that you've done you've done capital gain tax planning for with life insurance in the past, you should really go back to them and review the impact of these rules. I was working on a case with an advisor, and their tax bill overnight went up by 14 million. So it is, it's a big estate planning, and you need to have liquidity in the state to pay that. So, and life insurance is the best way to set that up. So there is always a cost to earning investment income through a corp. And this needs to be offset with, how long is the deferral going to take to be able to offset that tax? So if somebody's going to have to pay tax, if someone's going to take the money out the next year, subject to marginal rate tax planning, but let's say they're always going to be in the high rate, it's probably not quite worth the deferral opportunity, because it's going to cost them on interest income, it's going to cost them 4.4% more tax. On low rate gains, though, it's going to cost them 11.85% more tax. And on high rate capital gains, it's only going to cost them 293. So in that first 250,000 in gains, the new rules have cost people 11.5% or 11.85% by earning their capital gains and through their corp instead of personally. And that goes across all the provinces. So, PEI is the worst at 15%. So in those first $250,000 of gains, it's going to cost you 15% more in PEI than it would have if you'd earned that personally. And you can also see that every province is over-integrated on their investment income. So you will always pay more tax on interest income if you've earned it through a corp and then distributed out the after-tax money to the shareholders than you would have if you just earned it personally. And this is mostly because the rate has gotten so high that the refundable tax just doesn't make up for integration on investment income. However, if you're going to keep that money in the corp for years and years and years, you're probably okay with paying a little bit more tax, because that could be amortized over a number of years. So this also comes back to some compensation planning. So if you have clients that are just paying themselves dividends, they may want to revisit that, because the integration is now basically the same for dividends versus employment income on income under the small business deduction. It's always the case on income that's like over the small business deduction, because you'll pay more tax by paying the high rate inside the corp and then distributing out a dividend. So you should really consider annually the impact of dividends versus salary. Clients don't necessarily understand that dividends aren't cheaper. All they see is that the amount they see on their personal tax return, that rate is cheaper, but they forget to realize that they've already paid corporate tax to be able to pay out that dividend. So it's important to bring clients back and say, okay, you know what? Just because the dividend tax rate is cheaper doesn't mean the overall tax rate is cheaper. So what are the advantages and disadvantages of salary versus dividend? So so there's really no difference if it's the small business, if it's at the small business deduction level. Almost every province, though, you would want to pay, if it was over the small business deduction, you absolutely want to pay a salary versus a dividend. Now, salary is going to also reduce the corporate income. So let's say you've got, a professional making $700,000 a year and they need $300,000 for lifestyle. If they pay out a $300,000 dividend, they still have $700,000 in corporate income. But if they pay out a $300,000 salary, now their corporate income is only $400,000. So because it's only $400,000, as I'll show you an example in a second, they're not going to, the small business grind is not going to hurt them until more than a number that's more than 50,000. They also have now, maybe like for years, everyone was taking dividends and they weren't getting any RSP room. And, that could be a little bit detrimental for future retirement planning. So this gives them more earned income for RSPs. It reduces corporate income, as I said. The only potential disadvantage is that we've got potentially, we do have a higher cost for CPP, but I'd also say that that's a benefit because they're going to get CPP in their retirement. And there's also going to be a little bit of admin costs and admin work to do for payroll, but it's really not much. So if in Ontario we had business income of 150,000, corporate tax is 12.2, we've got 131.7 left to pay out as a dividend. The personal tax, this is assuming no other income. The personal tax on the dividend is going to be 24,832. So the after-tax cash to the shareholder will be 106,868. If we paid out a salary, they would pay 42,000, which is pretty close to this. The difference between the after tax for the shareholder is the CPP. But once we've maxed out the CPP, so if this number went from 150 to 250, this 7,700 is still the same. Now, however, the bigger benefit is if the corporate income was 450, we take off the salary. Now our income subject to the small business deduction is only 300,000. So therefore, we can make 50,000, which there's no grind to the small business deduction before the 50, but we can make an extra 40,000 of passive income before we're going to grind down below 300. So that salary has maybe given us a little bit of wiggle room on the grind. However, if we're now talking about income that's not required for lifestyle, when will they require the money? Marginal tax rate, what's their marginal tax rate going to be in the future? These are some things we need to talk about. What will the rate of return be expected on their funds? And what is the level of their AAII or their passive income now? And are there strategies to manage that annually? So a couple of strategies that we could look at are, types of income producing investments. What types of income do we have? And I'll show you how that can be helpful. Life insurance is also a very good strategy. Another one that I didn't put on here, but I probably should, is CI. So if you're using, CI as with return of premium, you can probably call that as a type of investment that's going to stay out of your taxable pool. So that might be another strategy to think of. So how can we manage our investments? Well, there are some, there are some investment products out there that limit their taxable distributions or have more efficient taxable distributions, like corporate class funds and things of that nature. So anything that's minimizing the amount of money that's kicked out into the corp that they're paying tax on is certainly going to help manage the passive income. You could tilt your portfolio towards growth stock that have no dividends, and you don't plan on selling them. So that's also going to, push forward income. But I always like to tell people that we can't let the tax tail wag the dog on our investment strategy. So if you are a non-risky type of investor, then buying a tech stock that doesn't pay any dividends and you're hoping for capital growth may not be the best place for your money. So investment allocation, however, can have a huge impact on the passive income rules, and I'll show you why. If we've got an investment portfolio that just has mostly dividends and interest, and we were earning 3%, we can have a portfolio of 1.6 million before we run into any problems. However, if we got 5%, we can only have a portfolio of $1 million. If we're getting 7%, we can only have a portfolio of 714,000. If we've got a balanced portfolio, though, and we've got 30% interest and 30% dividends and 40% capital gains, but we don't really turn our portfolio every year, then at 3%, we can have 2.7 million before we run into problems. At 5%, we can have 1.6. At 7, we can have 1.9, and at 9, we can have 900,000. But however, we're probably, if you've got high net worth clients, they're going to run into those problems relatively quickly. The other thing, so we can look at, in life insurance as a portfolio reallocation. As we know, we get tax-free growth. We protect against the passive income on investments. The new tax rules don't allow for, they allow a little bit for it, but if we know that the client's going to run into this problem in 3 or 4 years, you want to proactively try to go at them with a life insurance strategy, because it doesn't take long for that runway to run out. And once it's run out, it's really hard to rewind it. The other really good part of the life insurance strategy is we're setting, I kind of call them like corporate TFSAs. So we're setting money aside, it's growing tax-free. But the good thing about life insurance is if we're not using it in retirement, then we get the CDA credit out to the estate. For this type of planning, I know the previous speaker said that the UL will maximize your CDA, and he liked the fact that it didn't have cash value because that would reduce your capital gain on death. And he's right on both cases. If you buy a YRT 85 UL, you will certainly maximize your CDA. However, you also don't have access to the cash anymore ever, and you can't see it on your balance sheet. So that's a kind of a bit of a, that's a bit of a downfall from my side from my view. However, there are clients that would make sense for. In terms of the cash value of the whole life or products, and adding to adding to the capital gains tax on death. That is true, provided that nobody's done any planning for this individual. If somebody owns all the common shares, then that's true. However, as you know, most clients that I work that are in the high net worth are getting pretty good tax advice, and they've done things like estate freezes, and so they're minimizing the impact of capital gains tax on death. And that type of planning also basically makes the cash value in your life insurance policy not a factor when you're talking about capital gains on death. So you can plan around the cash value. So I wouldn't be worried about having cash value in a life insurance policy in terms of a high net worth person in their corp, because we can plan around that. And most people really like to have access to cash while they're alive, and they like being able to see it on their balance sheet. So I'm just going to quickly go through a quick case study. You got a guy that's 40, he's got $1 million already. He only has 450 in taxable income, so he needs 60,000 in AAII before we get into the grind. 200,000 a year saves, 6.5%, 25 years to retirement. Relatively balanced portfolio, but he's also turned his gains, his portfolio at 40% a year. So he does have some triggered capital gains. I just want to show you the impact of the new rules, the new capital gains tax rules. You can see that, you know, we've got no AAII in either one of these cases impacting his capital gains or impacting his small business deduction until year 3. But look at the difference along the way. This one gets tripped a year early. This one maximizes out a year earlier. And it's not significant, but it's, you know, you can obviously see it definitely has an impact. So let's put $100,000 a year for 25 years into a par policy. We'll maximize ADO. I'm comfortable with the current dividend scale. Portfolio continues to have the same investment mix. So we're only taking half out. Let's see what that does to our AAII. So we've got no insurance. We start to trigger the AAII year 3. We've maximized at year 10. Whereas this case, we put in an insurance, it starts to go at year 3, but we don't really maximize it till all the way down here. So here's the annual savings or extra money basically that we have to put into a portfolio or to an insurance policy each year. So 7,200, 11,000, 15,000. We end up with 167,000 more over time to have in the insurance portfolio. And I just basically call this a discount on the insurance. What does it do for assets available to us while we're in retirement? Well, this is the par policy and how much we have available to us in retirement. And this is if we just continue to do what we were doing in the old portfolio. And this obviously is the net impact to the estate. So either way, sorry, just trying to go back slide. Either way, we've got significantly more assets available to us while we're alive. And, you know, how they access the life insurance policy is, there's different ways to access it. But what I like to tell clients is stock markets go up and down. Once you're into deaccumulation phase, if we've got a 30% drop in the stock market, not the best time to be taking money out of your investment portfolio. Why not leverage your par policy that can't go down for a couple of years, let your investment portfolio recover, and then maybe take some money out of your portfolio. And I've been pretty successful with this on a number of cases with advisors and trying to stay on time. So with that, I'll take any questions we have. I'll tell a quick story, Don, if you want. I had a client meeting one time, and he said to me, he said, well, you need to worry about my partner. And I said, oh, I thought you told me you owned all the shares yourself. And he said, I do. So I was trying to figure out what he was talking about. He said, my 50% partner.
Right.
And I was like, I thought you said you owned all the shares yourself. He said, I do. I said, well, who is your partner? He said, Revenue Canada.
Exactly.
So he wanted to get rid of his partner. He wanted to know if there was a buy-sell agreement that I could put in place.
Unfortunately, no. It's like when the market did do a downturn a few years back, and that, my portfolio had been reduced by 25, 30%, I think it was. I said, I was going to call Revenue Canada and say, it's okay. I just lost your money. My money's still there. According to my chart,
right.
my money's still here.
Yeah.
Anyway, Chris, I think sometimes people watch these presentations and they get paralyzed because they go, oh my God. First of all, it's a very quick presentation, so it's hard to internalize the numbers and the examples. And I know that you do a very good job in working with your clients specifically and advisors of clients when you go do these cases with them on a joint basis. Can you just as a case stand out right now that you've worked on recently where you've had an implication as a result of the tax changes?
Um, well, what I've found, well, yes. I mean, as much as I dislike all of the changes that the government's made over the last number of years, it's been very good for my business,
Right.
which still doesn't sit well with me, but more and more, and not only that, they've taken away basically every planning opportunity that tax guys have, except for life insurance.
Right.
There's an accountant buddy of mine that I went to see, and he's like, I think I need to send some more guys your way. He said, because I used to have a toolbox and now I have a hammer.
See, another good line. That's pretty good.
Well, but I mean, his hammer was a state freeze. Like that's
That's it.
that's basically all
That's
they
it.
have left.
Well, the good news there is it calls for more insurance
Yeah.
when we do that. So that's I'm just looking if there's any other questions that have come up. Nope, that's all good. So listen, thanks very much, Chris. That was amazing as usual. I really appreciate your take on it. So it's always refreshing to have, again, like I said, it's always refreshing to have somebody who's actually doing it in the field every day, is perspective as opposed to someone who's just going through the changes and the book smarts of it. You actually have field experience. You're out there every day talking to clients and running into these situations. So I appreciate your viewpoint, and very good to see how you support the insurance sales with the estate planning and your advanced estate planning concepts. So thanks very much.
Well, thank you very much, Don. I appreciate the time and anytime. And if anybody has any questions, then you get any after, just let me know.